Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Catch your wave and you're sitting on top of the world. Don't be afraid to try the greatest market around. Those who don't just give up, gains abound. You just have to get in, but with the sell discipline. Catch your wave. Hello, folks. Welcome to the Easter edition of Your Money Radio. We've got a great show. Sorry about my voice. I'm like, who's that? Joe Cocker, whatever, with a horrible voice, but great lyrics. The market, catch a wave, and you're sitting on top of the world. The question is, when does the wave crash on the beach? All this week, from just friends and family and other people, the only question I get after, hi, how are you doing? The pleasantries is, when is this market going to roll over? This can't keep going up. It's a good question. Now, also, does BlackRock's Larry the Fixer Fink, or should we just call him the Finkster, does he have the answer to all of our problems here in America? Or is he just a conflicted broker full of conflicts of interest? He's the guy who thinks the boomers should fix our broken system for the younglings, for the younger generations, the end of the alphabet, the XYZs, right? And does he really want to, or is he just trying to ensure that BlackRock's future sales in the next generation are around? Or has Congress become the long-term threat to our economic well-being as a country? The stupid government spending. Now, if Fink is saying that the boomers were greedy and liking free stuff and never called Congress out on both sides, then yeah, he'd be right on that. Here's the problem, folks. Social Security and Medicare, Social Security and Medicare, $175 trillion of unfunded liabilities. We got three choices: slash beneficiaries, massive tax hikes, or cut everybody's benefits. There is actually a fourth solution, which is what we're doing. That is nothing. You'll crash the U.S. dollar, cause massive inflation, followed by a deflationary cycle. And then a reset. That's the great reset everybody's talking about. Oh, and in case you're thinking that we can just tax the rich, folks, these numbers are so big, you could tax the rich 100% and it still won't make a difference. The politicians lied. They stole your money. Now what do? We, the people, have to hold them accountable. And that's why I have this. Now, if time permitting, so we've got some great topics. We got the mailbag. We've got Teddy Bull's going to talk about the crypto miners, and Connor's going to go over small caps, which are actually looking better than the Magnificent Seven right at this point. And if time permitting, I'm going to talk about bonds and how they work. We'll probably have to table that for next week. And by the way, somebody actually did get held accountable just yesterday. Sam Bankman-Fried got 25 years. Hallelujah. Finally, some insider, billionaire politician or friend of the politicians finally got to see some real jail time. We need more politicians and more insiders wearing orange jumpsuits, and maybe we could have a better outcome. Now, I'm going to go straight to the mailbag first so that I can set up a couple of these topics, because these actually tie in perfectly, or at least I'm going to try. And boy, my wife would love this first analogy. She grew up on a working cattle ranch, unbelievable rider, beautiful on a horse, and she loves horses. So on 3/22, we got this from JP. He says, "Good evening, sir. I've been watching Bitcoin and the miners for a while. Plenty of horses in this race. The race just started. So consequently, there isn't much information on many of the horses. Based on price action and the small information available, it seems that ticker CLSK is acting like it wants to be a leader, if not the leader. They have been buying some of the other horses off the track. I know that price pays and that volatility, and they are volatile as anyone. What he's saying is they're very, very volatile stocks, yes. But they seem to bounce back nicely and seem to consolidate more closely to highs than some of their peers. I don't have the time nor the inclination to research as in depth as your staff does. I would love your feedback. As always, you guys do a fabulous job. I'm going to read that part again. As always, you guys do a fabulous job, and I always look forward to your content. Thanks in advance, JP. My response? We will discuss this on the show with Teddy Bull. We assigned Teddy to do that research, and we will get to that in a little while. 326 from DS. Oh, those are my initials. I didn't write this, but these are my initials. Hi, Danny. Your show was the best, and I listened to several financial podcasts. I do not know where the show is headed this week, but I don't buy the defined retirement issue. My research shows in my family circle and friends in the 60s, 70s, and 80s did not have a defined plan. They lived off savings without the 4% rule. They took money out as needed and paid, but cash paid 7 to 10% at that time. And a trade could cost $40 when they called their broker. Most pensions that others have shared were not that much, meaning most of his family that shared their pension amounts. Guessing the company invested in annuities that paid 3 to 4% on $250,000 or less. And it gave them some cushion, but they did not buy $1,500 phones, he means iPhones, or granite countertops for $6,500 either. One relative had $350 in Lilly stock and was not diversified, and he went broke spending it down in 08 and 09. But we did not have access to guys like you. They were all brokers. I'm going to read that one more time too. They were all brokers. Folks, if you have a broker, there's conflicts of interest, period. All right, side note. This is his side note. Matter of fact, pensions put you in a higher tax bracket. I have two, and now I pay 23% of withdrawals, trying to spend it down, but before I turn 73, so I don't have to pay such high RMDs. Oh, getting married, so now my distribution is going to be estimated at 28%. So that's the backdrop, and it's going to tie in with Larry the Finkster's solution and me. First of all, the important stuff. Congrats on getting married. I wish both of you the very best. And I'm switching gears now. I am not a Larry Fink fan at all, and he is a conflicted broker. He needs a 12-step broker recovery plan. I wonder just how many listeners still use brokers, which is akin to the horse and buggy, in my opinion. If your advisor is a broker, he has a Series 7, and there is a conflict of interest. And if they only have their Series 6, run. That means they only can sell you annuities or mutual funds, and they're almost always loaded mutual funds so that they get paid more and more larger amounts up front. You are correct. The 4% rule was designed years ago in the insurance broker world. Where they needed a buffer to provide a profit for the company to pay employees and staff rent and big commissions. Thus, they use a 4% annuitization rule while they make 8 or 10% on average and keep the remainder. If you can or have someone manage your assets fairly well, you can keep the difference after a much smaller fees. These annuitization schemes are like the Hotel California. You can check in, but you can never leave. Those 20 or 25% upfront bonuses are a dishonest scam. It is not a bonus. It is your own money back with just a slightly higher return over the long term because you never get your principal back. All right? And if you die early, you lose. The return is horrible. I will explain on this week's podcast, but this is your money, not their money. They think it's their money on loan to you. Thanks for the rant. Now it's my turn to rant, so stay tuned. Cheers, Danny. God, I love that setup. Well, let's talk about the annuities real quick, and then I'm going to go to Larry Fink's thing in a second, his article about fixing the problem. So, folks, when they talk to you about a 20% or 25% bonus if you sign up and you do the annuity right now to create urgency, what they're really saying is you're going to give them $250,000, $300,000, and they'll give you a couple $1,000s a month back for your lifetime. Income for life. It's not income, it's your own principal back. Okay? It's your own money back, your own money compounded. Now, if you do that and you annuitize it for life, there's certain exceptions on how you do it, but most of them, if you just get it for you and you get hit by a bus, that annuity, that whole principal, that whole $300,000 goes away, it's gone. That's how they guarantee you your income for life. Okay? But if they tell you it's a 20% bonus, that's only if you annuitize it and take the income stream for life. You give up your principal. So when they do your life expectancy and figure out how much you're going to get, they're going to assume some kind of rate of return. So if they give you 3.5% or 4%, but then they say, oh, we're going to give you a 20% upfront bonus, what they really mean is now they're assuming a 4.3 or 4.4% on your money. So they're just giving you a little bit more of your own money back after they make more money on your money and keep a big VIG. That's how that 20% bonus works. So just so we got that out of the way. All right. Ooh, this is another good one. This next mailbag is after my rant and is to all advisors who are really brokers and insurance agents, but want to break free of their chains of their broker dealers, AKA custodians. You see, broker dealers got a bad rap. Now that brokers kind of sound like a used car salesman because they work on commissions, the broker dealers decided they didn't like being called broker dealers anymore because now you realize they're just a middleman interfering with your transaction. So now they like to be called custodians. It sounds more fiduciary-like, which they're not a fiduciary. Anyway, so this is from 326 from SS. Hello, Dan. I wanted to let you know I've become a huge fan of you over the past several months and watching your this is Don. I'm sorry. Hello, Don. Don and Dan are pretty close. Hello, Don. I want to let you know I've become a huge fan of yours over the past several months after watching your interview with Richard Moglen, that's of Trader Lion, YouTube page, and learning a lot by watching Revere on your YouTube videos. And I wanted to congratulate you and Dan for the recent milestone of 150 million under management. By the way, very quickly, if you want to watch that Richard Moglen interview, just shoot Don or I an email, dan@revereasset.com or don@revereasset.com, and we will send you a link to that interview. The reason I'm reaching out is because I've been on somewhat of a similar path as yours. While my passion for my former career waned, my passion for investing and stock picking with a focus on swing and position trading has continued to grow. I decided to sell my business and make a career change. And over the past year, I was part of blank custodian, broker dealer, their financial educational academy. Okay. This route is grooming me. He got that word right. He's getting grooming me to become a salesperson. And now I'm working under some other financial consultants in a couple different branches. However, while I'm now on the right highway, my heart is telling me I'm not in the correct lane, as I wanted to get involved with portfolio management. I would greatly appreciate any guidance you have for me to switch lanes and pursue my desired career path. Hi, SS. Appreciate the kind words. Right highway, wrong lane is pretty much appropriate description. This is Don's answer, by the way. Portfolio management is based on having a successful documented track record. I started at Revere with a handful of friends and family accounts and proved my way into adding more and more AUM. It's not easy, but it's the only way. I found a needle in the haystack to get on board at Revere and help and able to develop the firm. A suggested starting point is to create a social media content, document your process and its edge, and be patient. Best of luck, Don. By the way, that Don Vandenbord, is now a 30% owner of Revere. So not only is he an employee, he is actually a shareholder, a large shareholder. The second largest shareholder, and there's only two. I just want to let everybody know we don't have a bunch of like private.
Who could the other one be? Who
Oh,
could
there
the
we
other
go.
one
Yeah,
be?
man. I just didn't want them to think we got a lot of. Hey, listen, some advisors, Don, actually have silent partners that put up the money and they're not active in the firm. They're kind of behind the scenes and don't. And you know, I'd rather have someone working here earning their. You know, I don't really want a whole bunch of silent investors telling me how to run the business. I love it when you tell me because you've got a vested interest. I mean, you've got. I mean, you're working here. Anyway, then this is my comment. This leads me to comment for advisors looking for a home with a book of business. That's an old brokerage term, meaning if you've got clients and you want who you want managed portfolios with a sell discipline and can prove their effectiveness. I'm sorry, let me repeat that. If this leads me to comment for advisors looking for a home with a book of business who want to manage portfolios and can prove their effectiveness because I have to sign off on it, or if they want active management by Revere, and then they can learn and grow with Revere and learn our system. In other words, if you can convince me you've got a good system with a sell discipline and you've got rules and it makes sense, you could actually come to Revere and manage money and not have to be dictated by their pie chart, asset allocation. Everybody looks to, you know, that kind of system. Also, we could actually manage it, and you could be out there and helping with, you know, the clients, the admin side. In any event, both of those kind of set me up for a couple of articles. Let me get the first one. So this was talking about Congress has become the biggest long-term threat to our well-being. By the way, all of these articles are in the show notes, so you can go read them if you want. Basically, it's talking about the deficits are at 1.8 trillion. They're quickly going to be reach 2.6 trillion in another decade, and it's just escalating. They're also talking about how Congress has become kind of gridlocked because it says over the past 26 years, it used to be roughly half or so of the seats were up for play each time, and it's dropped from 164 down to 23 of the number of districts that are going to be competitive. And now the incumbents are more worried about losing to a challenger in their own party that is either, if it's left, far left, or if it's right, far right, that is more bombastic and taking their place than the regular race after the primaries, right? And also the second one was gerrymandering, where they cut up the districts. And this is, look, both the Democrats and Republicans are doing this. Texas, the Reds, we're a red state. We do it to help the Republicans. Blue states like California do it to help their Democrats. It happens everywhere, and it really just has to stop. But anyway, so we're now left with Congress dominated by people far more worried about losing their seat to an extreme view in their primary than the general election. There's no room for compromise. And now what he's saying is now you've got extreme, you got flanks, you got larger factions of the far left and the far right in Congress arguing and not getting anything done. It's like the squeaky wheel. Maybe. Anyway, the other point he makes is deficits are rarely ever the fire closest to the barn. Boy, we got a lot of horses and barn analogies today. And basically, so it's always put off. Also, the major offset to the Fed's efforts, the Fed caused the problem. Now they're trying to fix it. Is the fiscal stimulus actually offsets the Fed trying to tighten. So in any event, it says these deficits we're currently running have only happened in times of war or recession. We've never had deficits like this when we had a decent economy. That's what they're telling us. And in any event, he's saying that the long-term issue with global higher inflation He said even Japan is raising interest rates. And he said we were now spending more on interest cost than national defense. He said we're lucky, the U.S. is special because our U.S. dollar is the global reserve frequency. However, it doesn't mean that Congress can continue to spend 8% of its GDP in perpetuity. In any event, it's a good article. And now, dovetailing with that is Larry Fink's article calling about the retirement crisis. I put two different articles up there. They're kind of regurgitated his speech he gave. And he's basically calling for a new thinking. And he basically is saying the world is facing a retirement crisis. We need a new thinking on pension. 1 in 6 people will be older than 65 by 2050, up from 1 in 11. And he said the tremendous amount of energy and helping spent on medical care is helping people live longer, and we're just not ready. But he says the main thing is the high levels of despair among young people in future generations don't feel hopeful about this country and investing. He said the baby boomers, he called the baby boomers out to help save the younger generation and their futures, to help them from this delusionment with capital markets and politics. He said it's no wonder that millennials and Gen Z are so economically anxious. They believe my generation, the baby boomers, focus too much on their own financial well-being to the detriment of who comes next. He's got a little point there. The rise of defined contribution plans also added to the strain on Social Security programs, leaving the U.S. particularly unprepared for the huge increases. Actually, no, these were the politicians and the corporations with their big lobbyists. So listen, in the 60s, everybody had a defined benefit plan, but you worked for the same company for most of your life, or maybe 2 companies for most of your life. You didn't go around like that. Not only that, these companies were putting the minimum amounts of their pension in to make because if you fully fund your pension plan, then it makes your income go down each year. It makes them look less profitable. So when you always get a range on those, they'd put the minimum. But the main thing is all of a sudden people in America got healthy. Back in the 60s, people drank and smoked. And so you retired at 65, you were dead at 72. They only had to pay a pension for 7 years. All of a sudden, people living 20, 30 years longer than retirement, their defined benefit plans were way underfunded. These corporations were getting in trouble. So they lobbied Congress to start making the employees do these 401ks, the defined contribution plan, where you define the contribution on the outside, right? You define what you're putting in, and then whatever it grows to is whatever it grows to. So part of that was the lobbyists, but it doesn't matter. And then he said, here's the kicker for him. More than half of the $10 trillion in assets BlackRock manages are for retirement. Here's his conflict. Pretty soon, he's going to see net outflows. All these baby boomers going to start taking their money out and live on it. And the younger generation isn't going to refill the coffers because of demographics and because they're worried about saving. So that is his issue. The other thing that he pointed out was that Social Security, he said, that Social Security didn't keep up. Look, here's the dishonest part about Social Security, folks. Here's the problem. It was supposed to be put in a trust fund, which they raided, and they took the money out and they spent it. Congress spent the money. It's not there anymore. You have been saving 7.5% off your paycheck ever since you started working. Your company you work for also paid 7.5%. So if you made $100,000, you were saving, whether you knew it or not. They were putting aside $15,000 a year for you in retirement. So if you did that for 10 years, you had $150,000. Plus, if any decent growth, it'd be $200,000 or $300,000. If you did that for 20 years, now you'd have double. You have $300,000. With compounding, it'd be $500,000. If you work for 30 years, $450,000. Now you're talking about $800,000 or $1 million. It's America does not. Us workers, the American workers, don't have a savings problem. They mandate 15% savings for us. Where did it go? You know, Australia, their Social Security, they call it superannuation fund. I can't pronounce it, it's hard. Where they automatically withhold 9%. Here's the kicker, they let you invest it. My sister is an Australian, married an Aussie, lived down there 30 years, 40 years. She's got a big retirement Social Security plan. Why? Because they let you do it on your own. In any event, with that, what is the solution and how do we fix it? Well, right now we're doing nothing, but we got to start holding people accountable. But more importantly, the moral of the story is you can't rely on the government. I don't care which side of the aisle. I'm not a Republican or a Democrat. I think they're all a bunch of liars. Okay? It's all about policy. I'm a constitutionalist. But the main thing is you've got to get back. You got to take care of yourself. You can't rely on the government to do it for you. So right now, the markets are absolutely on fire on a primary uptrend, a bull market. And that's why I'm saying catch a wave. Now, on a fundamental basis, I've been beating this dead horse. Valuations are very expensive right now. On a fundamental basis, it's very lofty. There's lots of blue sky. Last week I said, is blue sky to Venus or Mars? But the technicals are looking real strong. I would not be buying an asset allocation pie chart that's got some bad, especially with international stuff. And I wouldn't be buying without a sell discipline because it could turn around in a week or two. But it also could go up another 20, 30, 40% from here. You've got to be supple in your mind and don't get married. Don't be a perma bull and don't be a perma bear. Every perma bull I know and every perma bear I know goes through big droughts and gets slaughtered. And then they have to go make it all back again. Sometimes I'm bearish, sometimes I'm bullish, depending on what signals I'm getting in real time from the markets. So with that, Don, I've got one more. Oh, no. So the first one, Don, I'll throw that over to you. So the big over-searching topic is catching a wave. How do you know when to get off the wave without crashing on the coral reef, right? And then Teddy's going to do his Bitcoin, and then Connor's going to do the small cap. So however you want to take it, it's your lead.
Yeah, we'll go with ride the wave, and we're very consistent in our approach. We invest over 3 time frames. The short term, meaning what is the trend versus the 21-day exponential moving average. That's the green line on this chart of the S&P 500. But it applies to every security, stock, ETF, everything that we look at. The medium term moving average, which is the red line, that's the 50-day simple moving average, and the long term trend line, the black line, the 200-day moving average. No bear market has ever occurred without a break below the 200-day moving average, the black line. So if you do little to nothing on your investments and you just make sure that you're above this black line, you're never going to get hit in the back of the head with the 2x4. We're more active, obviously. We look for the strongest markets, and then we look for the strongest stocks in the strongest sector within those markets. And we followed our rules, got in back at the beginning of November with the O'Neill follow-through day, and it's been just ride the wave since then, ever since then. Now, this is an extremely long period above the 21-day moving average. But I could have said that 2 weeks ago. I could have said it 4 weeks ago. I could have said it 6 weeks ago. But we use our rules to get us out, not our opinions. And there's been a lot of opinions, particularly with a few inflation numbers that ticked up instead of ticking down. Initially, back in January, the market was expecting Jay Powell to start cutting rates in March. He said there's no way we're going to start cutting in March. And regardless, the market has just continued to grind higher. If you read the headlines and got out, you're just giving up on a trend that is in your favor. And the saying goes, the trend is your friend until the end when it bends. And it'll be very clear when it bends below either the short-term moving average, and then maybe it'll stop at the medium-term moving average and we'll just lighten up a little bit. In other words, our short-term money will come out of the market and we bounce there. But we're not predicting. Bull markets don't typically end after 4 or 5 months. They typically go on for quite a long period of time. But I think the country is just so conditioned to negativity with COVID and everything that we saw. You know, the market went down 35% in 5 weeks. We recovered. Then we had the whole year, 2022, a bear market. And, you know, that was supposed to be because of gloom and doom inflation or recession that never came. And now the Fed's base case is for a soft landing and no recession. So the arguing with the market is, you know, you can do it. Does it make you feel better if you're watching something go in a continued trend that because you have a certain opinion, you're disagreeing with it? The price is the only thing that pays you in the market. And you know, we get stopped out on individual names all the time or sector ETFs, but we haven't been stopped out on our market longs that we initiated back in the beginning of November. We've got leveraged long S&P 500 that are up over 70% because the market's just been that strong. The trend hasn't broken, and we're just riding that wave. And anything else is, you know, this could end next week. We don't know when it's going to end, but as of right now, I gave that 5074 level last Friday, which was the breakout level from Jay Powell's press conference, and we haven't breached that. And until we do, the short-term trend is going to continue to ride higher. And now the 21-day moving average early next week will come up to that 5074 level. Right now it's at 5174. Right now it is at 5166. So should be Monday when the market reopens. We've been rising about 8 points a day on the 21-day moving average. And that gives you an additional level of support. So when the 21-day moving average is above the pivot, now you have 2 levels of support. At some point, the 50-day moving average, if we continue, that'll be above that pivot, and it'll give you intermediate term support. So we're not arguing. We're just riding the wave. We're here every night explaining what we're doing, why we're doing it, and we've been consistent in our message. And we're wrong a lot, but we're not wrong. If we're wrong, we don't stay wrong. If we're wrong on something, we cut our losses very quickly. The typical stocks that had led this initial run up, which were tech related, haven't outperformed over the last 3 weeks. It's been more a rotation into oils, into copper, into home builders, into biotechs trying to get a resurgence, and small caps now. And small caps and mid caps starting to outperform. So we're always keeping an eye out for where's the relative strength and investing accordingly.
Let me make one point real quick, because that's a great point. So Don's talking about, like, if you have a preconditioned biased or view, like if you think the market's overpriced, you think it's going to come down. You look at that chart he's just showing. Hopefully you're watching this on your computer or your iPhone too, not just listening audio. But he's got a chart up, and the S&P is above the 21 exponential, the 50, and all, you know, the stacked moving averages. But if you've got a bearish slant, you assume the reversion to the mean is going to come down to the 21 or down to the 50-day. So you're looking for that coming down. But there's actually 2 ways you can have reversion to the mean, which Don was explaining. What he was saying is price can actually pull up the mean. So if the market continues higher, those lines, those moving averages actually get pulled up. It does not have to revert down to the mean. The mean can revert up to price. That's very important. People always think the reversion happens to the downside, not to the upside. Go ahead, Don.
Yeah, that's what happened back here late December, the beginning of January. We went sideways for about 4 weeks, and the moving average caught up to the price and it bounced. We had 1 day below the 21-day moving average in the last 100 trading days. And so 99 out of 100 days above the 21-day moving average. Very long time. But like I said, 2 weeks ago, 4, 6, 8 weeks, all the way back. Everybody's looking for a correction, and we pointed out that famous Peter Lynch saying several times over the last several weeks that more money has been lost waiting on the correction than during the correction itself. So, this is our process at Revere. This is what we do.
Yeah, and listen, when you start getting a correction, you'll know it. And especially a bear market. Bear markets are not that hard to identify. You may give up the first, your portfolio may decline, higher single digit, but you don't have to give up 20, 25%. You don't have to go through that.
Yeah, and rotate. Ralph Acampora is a famous technician from back in the day, and he said that sector rotation is the lifeblood of bull markets, and that's really what we've seen over the last month. Yesterday, the S&P 500 was up 0.86%, but the leading tech stocks, I showed a screenshot in the video Wednesday night. They got hammered. And it's just sector rotation, people taking their profits in there. A lot of changing in allocation happens around the end of the year, end of the quarter.
You got to have that window dressing. Got to have that window dressing.
Well, it's odd. You normally don't sell off the strongest stocks for your window dressing.
Well, that's true. That's true.
But that's again, we're not guessing. Some of our things that we had profits in, we trim them as they came back and broke relative moving averages, and we'll let the market makes the decisions for us. We just stick to our rules.
Yeah, the stocks get taken out by mechanics. Actually,
yep.
Yeah. All
right. So let's segue over to Bitcoin and the Bitcoin miners. Ted's got a really nice presentation. Take it away, Ted.
Yep. So we're talking about. Well, I just want to preface that if you're here for a crypto advanced session, this is not the segment. This is pretty much a higher level overview of Bitcoin and Bitcoin mining in general, and talking about the various instruments in the equities market in which you can play Bitcoin. So I was just going to talk about a few miners and then ETFs as well as MSTR. And so Don has a 3 miners chart up, but I'll talk about MicroStrategies first, a ticker MSTR. And this company is headed by Michael Saylor, who is a very just popular Bitcoin investor. He considers himself a HODLer, and that's a term that the crypto community kind of uses a lot, which means they just hold without selling at all. And he considers himself a HODLer for life, and he's never willing to sell unless he gets liquidated. And I'll talk about that in a second. And so as of March 10th, 2024, MicroStrategies holds about 205,000 Bitcoin. Saylor and the crypto community sees MicroStrategy as a leveraged Bitcoin play. But since they constantly buy more Bitcoin with debt financing, MicroStrategy constantly trades at a premium, which gets dangerous because it's really unpredictable when it will pull back and revert to the mean. It doesn't fully correlate with Bitcoin's price action. So you can see MicroStrategy is down over 10% today. And Don, if you can go over to IBIT, which is probably the best Bitcoin proxy in the equities market that tracks the Bitcoin price, it was actually up 3% today. And so Bitcoin was up about 3% today. So continuing on, just talking about the 3 miners and just comparing and contrasting a little bit on a higher level overview, I wanted to talk about 3 things: the number of Bitcoins each miner holds, its hash rate, and production costs. But before I start, I want to define hash rate. And that is essentially the measure of how many calculations that can be performed per second in the context of Bitcoin mining. So it's like the speed at which a computer can solve one of the hashed algorithms to mine a Bitcoin. And so gold miners go into the ground to find gold, but Bitcoin miners have to solve these complex mathematical problems to mine Bitcoin. So the first company is Mara Digital. It's one of the older dinosaurs in this space, the more established company. It has a hash rate at 28.7, and then that's just the unit. They hold about 11,400 Bitcoin, and their production costs are very high because when you have higher hash rate, it takes more energy and computational power to fuel that, to reach that hash rate. Second, we have Riot at about 12.4. They did talk about bringing that up to about 15 by July. They hold about 7,600 Bitcoin. And their production costs, just in terms of this relativity, I put it as a medium. And finally, seems like the market agrees with it too. CleanSpark at 16 holds about 3,600 Bitcoin. They have one of the lower hash rates, but they also have the lowest production costs because of their greater access to renewable energy. And these Bitcoin miners, they don't really make money because it takes so much energy and expenses and overhead to mine the Bitcoin. And as Bitcoin's price increases and the supply gets cut every 4 years from the halving, hash rates just go up. So it takes even more energy to mine the Bitcoin, and the difficulty increases as well. So overall, these miners, like MSTR, don't really track Bitcoin's price well. Don, if you can quickly just show the three charts, and then afterwards show the chart of IBIT, you'll see that today the miners were all red while Bitcoin is green. And on top of that, they have some extreme volatility. It's very much a trading vehicle, not an investing vehicle. If you were to look at their longer term timeframes, it pretty much just chopped sideways in a massive range. It's really hard to catch a trend of any sort. So yeah, Don is just putting the charts up. Just very choppy price action. Even trading wise, it's very tough versus Bitcoin's actual price action, which will come up on the IBIT chart in a second. See how the trend's a lot smoother, and that correlates with Bitcoin almost 1-to-1. So heading on to the ETFs, we have about 3 ETFs, and these are even just, in my opinion, they're just even worse proxies than the miners and MSTR, and definitely IBIT. Most of these are filled with a bunch of junk. I did highlight the top 3 holdings, which are either CLSK, CleanSpark, Mara, Riot, or MSTR. As you can see, WGMI has NVIDIA as their third top holding. Block, which is the most diversified, which lowers its average true range and makes it least volatile, has so many random companies in there. Just a few examples. They have Roblox in there, AMD. They have TSM in there, Oracle, MasterCard, Visa. They even have Walmart in there. I'm not sure how Walmart has to do anything with crypto and blockchain. They have Meli in there, Mercado Libre. That's a Latin American, I think, e-commerce platform.
Yep.
So it proves the point that these are crap ETFs for Bitcoin proxy. And that brings me back to IBIT, which is BlackRock's, or FBTC, which is Fidelity's, are probably the 2 best, most liquid, and I guess highest correlated to Bitcoin itself. And those are probably the instruments you would want to use if you're an equity investor trying to get Bitcoin exposure. Or the alternative is buy Bitcoin itself through crypto exchange or decentralized exchange.
Good stuff, Ted. We stumbled across HUT also. What that is kind of trades on the thin side. Do you know what the ATRs are on these off as part of your research?
Does an ADR work? I have ADRs right here.
Yeah, sure.
Hand.
Right.
Yeah. So let's just give a comparison. CLSK has a 20-day ADR of 14%, HUT 10%, Mara 12%. We have other crappier Bitcoin names like CIFR 14%. MSTR is about, 13%. So in a day, they're swinging on average 10%.
Yeah, and that's on average.
These are more day trader. These are more day trader names than if anything.
All right. Anything else?
No, that was just a high level overview of some miners and the ETFs. I'll just conclude that IBIT and FBTC are the ones you want to go to if you want Bitcoin exposure.
Yeah, I think that point you made about CleanSpark being having the lowest energy production costs because of access to renewables pretty important, and especially with the halving coming up, it's going to be twice as hard to mine a Bitcoin. Which I guess, does that mean it's going to take twice as much energy? I guess it does, right?
Yeah,
So
exactly, and
it's going to weed out.
exactly.
It's going to weed out the less efficient miners. The more efficient miners will have an edge.
Exactly.
And the fastest computing.
Yeah, or they just loot. Yeah. So another thing I looked into is that these miners, the more legacy ones, are able to survive because they continue mining during the bear markets of Bitcoin, so they can accumulate that Bitcoin and hope to sell it for higher prices. But higher Bitcoin prices are actually counter to what these miners would hope for in terms of profits.
Yeah, when they're mining.
Or making money.
Yeah, and the miners that have been around for a while, they've already have some Bitcoin in their inventory, so they've got some inventory to help buffer the volatility and the down cycle.
All right, good stuff, Ted. Thanks. Connor, you're going to talk about the small caps today?
That's right. Maybe this time the breakout can stick. So, yeah, I want to talk about small caps today. Some nice developments occurred this week. And, we've covered them a couple times on the show, and they've looked good a couple times, but really no momentum has stuck. And this week there were some positive developments, so I'm going to go over those. And so that first chart, I've showed it multiple times, but when you look at this chart, I mean, this is the weekly chart of IWM. It's been going sideways now for almost 2 years, and it's been in a range between, $160 is the low end of the range and 210 is the high end of the range. And here we are back into the top end of the range and breaking out. Yesterday was the 52-week closing high for IWM, so that is significant. And two other main things is it continues to trade above both of those anchored VWAPs from the COVID low and the all-time highs. And that's two main pivots that that price is above, and that furthers the bull case for a move higher. And it's peeking its head above that flat base breakout yesterday and followed through to the upside today with a little bit of a weaker close. And if you pull up the next chart, Don, and this is, I'll just be real quick with this once Don gets it up on his screen. Yeah, this is just seasonality chart. Seasonality suggests that small caps could outperform into April. So that's another reference point that furthers the bull case. That's just something small. And you can just go back to the Market Smith chart now. There were some other notable developments. If you pull up the IWM daily, Don, we're starting to see small caps outperform, and that's noted. The relative strength line is getting back above that 21-day moving average. And when you look at this chart, the moving averages are very nicely aligned. The 821 50-day are trending up, and the 200-day is sloping up, which is positive. And when you compare that to the NASDAQ relative strength line is actually making lower highs, and it's trading below that 21-day moving average. So that's telling us that, maybe money is going into small caps, and maybe they could start to outperform in the market. And this has been evident a little bit with how some of these smaller speculative names have been trading quite well. And, the last week, when you gauge mega cap, market cap performance stocks, small caps have been leading. And just a few fundamental points. I thought these two statistics were pretty interesting. The price to book ratio of the Russell constitute companies stand at only 44% of the S&P 500. And this is saying that small caps are still quite discounted. And historically speaking, small caps have done well after a period of bad breath. In 2023, wasn't necessarily bad breath, but it was also a narrow market. You had, the Mag 7 that was really leading. And historically speaking, I saw this stat on Grok that small caps can outperform after periods like that. So that's notable for sure. And yeah, that's really it. That's what we're watching. I mean, IWM's checking a lot of boxes in terms of price action. There's some fundamental drivers that I think are good to know, but overall, price is going to tell us if small caps are going to go and outperform moving forward. But from a technical standpoint, I think they look fantastic here, and it's a great area of the market to watch because I think it will only further strengthen the rally.
Yeah, you can see off the bottom in November, the relative strength line, there was some serious outperformance from November into the beginning of January. And since then, you see price finally making a new high on the Russell 2000, but relative strength has been lagging. If we get this relative strength back, you showed the chart about if we break through this, and we're right at, and in fact did poke our head above this resistance area, there really is room to run, and it can really run fast if we get the right environment and on a relative strength basis. It's more apparent here. You can see how strong that relative strength was during this move up off the bottom in November.
Yeah,
good stuff. Dan, from a I think that's it from a market standpoint. The market's closed now. It's 4:41 Eastern time. So first quarter ever, we closed with over $150 million in AUM. And we appreciate all the clients out there and the people that are telling their friends and family about us. But one thing, we talked about this in-house this week. We always get a bunch of clients when the market is going up, but the time, or also after a big, after a big correction, we've been getting a lot more with Ted and Connor's social media presence and the great content that they put out there. Combined with the nightly videos, there's really been a lot more eyes getting on what we do here at Revere. And normally our biggest inflows are after somebody gets their butt kicked in a bear market because their advisor had no sell discipline for them. But the time to come to Revere is when you've got all these gains, because we're the ones that'll get you out and protect the downside when the market does its inevitable rollover. And we're not predicting any rollover or when it's going to happen, but we know that there have been 3 bear markets since 2018 and 0 bear markets at Revere. We just follow our trend rules and get the heck out of the way when the market tells us. We're capable of determining a healthy market from a risky market. And right now the market is healthy. And if it gets more risky, we'll pull back. And if it breaks the 200-day moving average, that's the ultimate line in the sand where all bear markets occur. Right now, we are the S&P 500 is 13.8% above the 200-day moving average. That doesn't mean that you would lose 13% before you would break the 200-day moving average, because of the trend. The slope of this line continues to go higher. So if the market goes like this, then pulls back, and then finally, if we did have some sort of a bear market, you'd be breaking the 200-day moving average. It wouldn't be a 13% loss from here we are now. In fact, our balance at risk calculation that we use is less than 4% before we would either start hedging or all of our stops would get taken out for what we have in the market now.
You're talking about our REBAR, Revere Asset Balance at Risk. That's the if all of our stops got hit at once.
Right.
Right. Okay. All right, folks. Very good. Ted and Connor, that was awesome. And folks, listen, have a safe and happy Easter and have a 3-day weekend. We're certainly going to enjoy it tomorrow, Friday, because the markets are closed. And these guys work their butt off. They put in lots of hours every day. The markets are open, and they're even sending charts and graphs on the weekend. You'd be surprised how much. So hopefully they'll actually enjoy themselves tomorrow rather than looking at charts and graphs. But I think that's actually how they enjoy themselves. I've come to realize they can't help it. They're just stock nerds. Folks, listen, if you like what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com. Up in the right-hand corner, there's a subscribe button. Just have them put their email and their name in. We're not going to spam them or hassle them in any way. It's up to them to reach out to us if they want a complimentary portfolio review or they want a topic or a stock discussed on this show. You can also, next to that is a contact button. You can comes to me directly, email, or just email me, Dan@RevereAsset.com, Don@RevereAsset.com, Ted or Connor at RevereAsset.com. And you can always call us old school at 855-REAL-WEALTH. Remember, Bill O'Neill said anybody can get you into the market. Who's going to get you out? You've got a lot of gains right now. Who's going to get you out? We'll talk to you next week on Your Money.
Because it's not about how much you make in the markets. It's about how much of that you can keep.